So we got S&P 4246. Man, that 4250 level has been stubborn. Let's get to Bob Pisani. Hey, Bob.
And new highs, though, there. And that 10-year, 1.46. That's the one part of this puzzle the traders have gotten wrong. And as a result, we're seeing some people a little bit off sides right now. Let's take a look at the sectors. A little bit of a different trend today than there has been in the last week and a half or so. Energy's always been the leader. It's been fabulous with oil near $70, new highs there. But materials, industrials lagging a little bit this week. Tech's been doing a little bit better, and healthcare. The important thing is just this whole value versus growth trade. This can be very confusing to understand, but generally growth has been returning in the last couple of weeks. If you take a look at the sectors that are moving, what's growth? Growth is usually associated with technology stocks and healthcare stocks, not always. And value is usually associated with industrial stocks, energy stocks, material stocks, some bank stocks, small cap stocks. And as you can see here, growth has kind of come back in the last few weeks. Value stocks have sort of lagged behind here. And the reason this is happening is people are starting to rethink the market narrative, particularly about the impact on yields here. So remember the old market narrative, and what the market's gotten right is we've got a big reopening on our hands, and we're going to have really good earnings growth. The mother of all earnings reports is coming in the second quarter. We're talking about 60% growth in earnings in Q2, strong in Q3, but decelerating a bit. Still growing, but the rate of change is decelerating. And what the markets got wrong is the whole inflation leading to higher yield story. It was wrong. So far, it's been wrong. Inflation and supply chain issues right now, the Fed may be right. They may be transitory. A lot of worries about labor costs out there, and that's, I think, a big question. We haven't resolved that, but right now, that's the thinking. So here's the current market narrative. Q2 and Q3 is going to be peak everything, peak earnings, peak economy, etc. Inflation, well, notable still, but maybe transitory, maybe not on labor. That's a big debate right now. Yields still staying low. And, of course, that pain trade. What would cause the greatest amount of pain to the greatest amount of traders? It's rotate into growth, because there's people who are offside that are on that value side of the equation right now. So the result is we're seeing money move back into a lot of tech. Remember all that Cathie Wood stock, all that stuff that was out there that had 50% declines, things like Zoom and Roku? They've stopped going down. In fact, in the last couple of weeks, I wouldn't say there's a tremendous rotation here or a tremendous rally, but they're well off of the lows here. Zoom, Roku, Shopify, other stocks in her arsenal, Spotify, for example, Teladoc, they've all stopped going down and started slowly creeping up. Volumes are not immense, but you can already see people who are thought leaders, like Tom Lee, starting to talk about how to change the narrative a little bit. This is very confusing, Carl, because a lot of people message me and say, wait a minute, why are we supposed to rotate into growth when growth is slowing down? And it's a little counterintuitive, but growth tends to perform better in the back half of an economic expansion. Essentially, they do better in the late stages of an economic recovery. And that's the main reason people are starting to talk about rotating back into growth.
Shepard Smith here. Thanks for watching CNBC on YouTube.